just giving everyone a few moments to join the room and get comfortable. Hello, everyone. Okay, it's time to start. Thank you, everyone, for taking time today to be here in this TradeStation webinar. We are going to do options replay. If you've been part of the series, you know the mechanics already. We are going to single out some trades and talk about the reasons why a trade works or doesn't work. And for that, we have our guest speaker, Brandon Wendell. He's a friend. He's also a trader and also a mentor. We're gonna get to him in just a moment. I just have to go through some introductions, some disclosures, and talk a little bit about what we're doing here at TradeStation. For those that don't know me, my name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. I want you guys to be aware that every symbol and idea that we talk about here today is for educational purposes only, that these are not recommendations of TradeStation. Also, active trading, not suitable for everyone. Be aware of the risks when you trade online, especially when it comes to options, which have a higher degree of risk. And also any examples and past historical performance is only that, examples, and there's no guarantee of future results. One more thing, Brandon, even though it's great to have him here, he's not affiliated with TradeStation, so his methodologies are his own. We're glad to have him so he can share his expertise with us. Okay, if you need more information, go to tradestation.com/important-information. In addition to that, we'll get to Brandon will talk about himself in just a moment and where he comes from and where he got all his experience. But I wanted to talk to you about our upcoming in-person masterclass. If you haven't heard of it, it's going to be in Chicago, September 24th, and it's a masterclass with a focus on derivatives. We have a great lineup of speakers that are going to join us that day, and I want everyone to not only be aware of this, but also register if you have an opportunity to travel and attend and join us for this great event. I am going to be sharing the link that provides you more information about the event, who's going to be there, what the event entails. If you guys have any questions about it, please make sure to send those questions to me either via the chat or email. I'm also going to post here an offer code, there it is, in the chat that gives you a $100 discount towards the registration fee. So make sure that you save the offer code, click on the link, bookmark it, and so that you can read about it later and join us for that special event. Thank you, everyone, for being here. I'm just going to stop my share and pass the microphone over to Brandon. Brandon, the floor is all yours, my friend.
All right. Thank you very much. I was just answering, yes, all of these are recorded in the options replay page, which I'll go ahead and show you where everything is available. So let's see, I'll share my desktop with you now. There we go. Actually, before I go into who I am real quick, I'll just show you where everything's available. If you go into tradestation.com under Learn, you can go to Options Education, and you'll find Options Education Center. And if you scroll down a little bit, you will find there it is, Options Replay, which is what we are currently experiencing right now. So it is recorded. You'll be able to watch the previous. You can join us if you're not here right now. Just kidding. And you can see that there's also some webinars that we've done in the past. And actually, the one I'm going to reference today is right here, Wealth Protection for Volatile Markets. I was invited to do a webinar with TradeStation earlier this past week, last week, that is, and I got a bunch of great questions. And I said, you know what, those are more appropriate to discuss in Options Replay. So here we are. Real quick, for those of you who may not know who I am, I'm a charter market technician, which is basically a master's degree in technical analysis. I got involved in the markets years ago, almost 30 years ago, as a retail broker. I hated it, and I moved into back office operations, where I became a trader for the brokerage, basically. So I did order flow activity, where officially they call it agency desk operator. I was handling order flow from customers coming in, retail, as well as institutional trading. I ended up parlaying that into a career in the hedge fund industry. I was a private hedge fund trader for a while and hated that too. It was a little stressful, deciding, you know what, I got knowledge, let me just trade for myself. And I started doing that, and I screwed it all up like a lot of people do. I realized I wasn't quite ready to trade my own money. It's much easier trading other people's money. And I went back to school to learn more and work with mentors to get better at trading. And I did. Since then, I've been trading as a trader full-time, as well as I became an educator part-time, because I not only wanted to help others, but it actually helps me as a trader to be continuously reiterating those rules and constantly pounding those rules into other people's heads. It does it for myself. So it makes me a better trader to stay active doing that. So I've done the media circuits, CNBC, Bloomberg, Fox Business, all the good stuff. Anyway, that's enough about me. It was not about me. This is about you guys and trading. And as I mentioned before, this past week, there was this wealth protection for volatile markets, which we obviously are experiencing a lot of volatility in the markets. If I go out to, here's the TradeStation desktop that I've got right now, and implied volatility has had some major spikes at times, although it's not extremely volatile right this moment. If I zoom in a little more here, this is again the broad market being measured by the SPY. And you can see that we get our little spikes and drops, spikes and drops. And often when we get rises in volatility, we get drops in price. And the reason why is that volatility is often referred to as an investor fear gauge, and investors prefer nice, calm, upward moving markets. They get nervous when markets go in a downward direction, and if they accelerate, it makes them even more nervous. Even the potential of a downward move gets a lot of volatility. We actually have a lot of information coming out this week, as a matter of fact. Last week, if you take a look at the S&P, you can see on Friday, there was a huge jump. And if I take this down to, say, a 60-minute chart, you'll see exactly when that jump occurred. And I got to get rid of the indicator for now because that won't work. There we go, disable. It's a daily indicator only. And it happened basically at 10 a.m. So actually, if I take this down, let's go to a 15-minute chart. There you go. You can see exactly when that happened. 10 a.m., it's labeled as 10:15. That's the end of that candle. So it's showing you when the candle finished at 10:15. It started at 10 a.m. And the reason behind that is there was a comment from the Federal Reserve at Jackson Hole, Wyoming, that there may be a possibility of a rate cut in the near future, nearer rather than later, sooner rather than later. So volatility would also jumped, even though prices went up. Volatility can rise when you have a big move in price very rapidly. The reason why I bring this up is because some of the things that the Fed takes into consideration when they're looking at what's going on in the markets, we go out, and today we don't have a lot of news. I happen to use Forex Factor. There's a lot of different websites for news, but there's calendars right there. And what I'm going to be focusing on, watching, and probably a lot of other people, is on the 28th, Thursday, we have preliminary GDP numbers coming out. So we want to see, is the economy functioning well? Are we growing? Are we producing as we should be, or are we contracting? And we're actually looking for a slight increase in GDP, which would show an increase in production, obviously, for the output of the United States. More importantly, Friday morning, this is why I brought up the Fed, prior to the equity markets open at 8:30, that's the wrong one. Here, we have the US dollar core PCE price index. I forget what it stands for. But anyway, it's the Federal Reserve's primary inflation measure, personal consumption expenditures. The Fed is going to be heavily watching that, and there may be an increase in volatility based on that number coming out. They're expecting it to stay steady, but should that number rise, which we saw in the last quarter, actually in the last month, sorry, it's not a quarterly, it's a monthly, it went from 0.2 to 0.3. Back here, you see we went 0.1 to 0.2. We actually had a surprise rise in that number. That's inflationary. And things like that can cause the Fed to hold back on those rate cuts that they've been hinting at it possibly happening. And of course, the executive office wants that to happen as well. So that could increase volatility in the markets. What does that mean? It means you need to be proactive, not necessarily reactive, and be able to protect yourself if necessary. So that's why we started talking about what's been going on with the volatility in the markets. And the nice thing is, if you click on that link, I was there, in the Options Education Center, there is a lot of information. There's more that's going to be added as well coming up. But you've got explore strategies. There's different strategies in articles. So there was the webinar that I did that I was guesting. And again, there's articles, I believe, if we go into explore strategies and more details about some of the strategies that are available for protecting yourself. Oh, there we are. Wealth protection. I think it's in there somewhere. Anyway, yep, there it is. If you scroll through, it goes through some of the different strategies. So like I said, I did that webinar and I had a few questions. I just copied them out of the chat, so they're in a text format. I apologize. But basically, one was, can I share the IV workspace that I used? It's hard to find the best indicator in TradeStation. It depends on what you're looking for. That was a question from Sam. What I use in the workshop is pretty simple, a workspace that I created. And all I did was open a chart. I think I have a radar screen and a trade manager open as well. And I disabled them, but let me go back to a daily chart. And if you're looking for implied volatility, there are several different studies, obviously, that you can use. Let me go back to my edit studies. And I have, implied volatility, all options, I believe is what I used. Turn the status back on and turn this one on. There we go. The only one that's unusual and not part of the basic family, if you will, of indicators, because this one is implied volatility, all options. That's the normal one. If you go to studies and add study, you'll find it. You just go under indicator, and it's right there, implied volatility, all options. And there's others out there too. You can measure implied volatility versus historic or a couple of deviations, all kinds of good stuff. Doesn't matter. Now, this one's a little different. This is the implied volatility range percent. That is also available. This is something that I gave some inputs to, and Jesus actually created this indicator, and it is available. Let me see now if I can remember exactly where it is. It's in the Options Education Center. It's one of the downloads for workspaces. And I'm trying to remember which one it is now. I will find it. Might be Iron Condors.
What's the name of the study again?
It was the one that you created, the implied volatility IV range percent.
Okay.
And I'm trying to remember where it was available, because if we put it in one of the workspaces, which I'm not going to find it now that easily, am I?
Yeah, I think it was one of the initial articles that you wrote.
It was, yeah. Let's see, is it in here? No. But it's in one of those workspaces, I know. It's one of the earlier ones. Might have been, actually, it might be is it earnings? Was it that early? Straddle opportunities for earnings. It might be in there, but I don't want to spend too much time, but that's where the other indicator is. Now, what that other indicator does, and it's not necessarily something you absolutely need to have, but it's something you could definitely use if you know how it works, and it's something that kind of lines up with what you want to do. It basically takes the 52-week historic volatility. There it is, IB range percent. It is there. Okay. So I found it right away. It's the very first strategy and workspace, the straddle opportunities for earnings. If you go to that one in the Options Education Center and under download workspace, it'll actually download that indicator with, it's an ELD with the workspace. So there you go. And basically what it does, as I was mentioning, is it takes the 52-week historic volatility, which is basically your chart. Historic volatility is what's happened in the past. And it breaks it up into 5 quintiles. And basically the first 20%, 0 to 20%, 20 to 40%, 40 to 60, 60 to 80, 80 to 100%. And the reason why I had that divided is because it gives me an idea of how implied volatility, that's what this yellow is charting, the current implied volatility versus the last year's range between high and low. So you can see right now the spiders SPY on a daily chart, and it only works on dailies, is the current implied volatility is about as low as it's been in relationship to the historic volatility for the last year. So what does that mean? Overall, it simply means that options are probably relatively cheap. And we can test that theory by going out to OptionStation Pro and get a look at SPY. Now, this is not exactly 100% accurate. It's a guesstimate, but looking at the option chain, let's say we go to just tomorrow's options, you take a look at the theoretical value versus, and the market closed, so we're not going to get as accurate of pricing as we would while the market's open. But right now, if we could buy an option 642 call for 292, its theoretical value is 298. We're buying it under value, aren't we? That means the options are a little bit cheaper. Even the put is valued at 237, but we could buy it right now for $1.81. Well, that would suggest that the options are underpriced. If we find a security with high implied volatility compared to historic, then the options might be overvalued, and therefore you'd be more leaning towards selling options rather than buying them. And there's a couple ways of finding some of those. One of the easiest ways, honestly, would be to go to a radar screen and create a hot list. So actually, I already have this one open. I can change it to implied volatility highest. And we can see that this is the implied volatility range percent RS. That's for the radar screen. The other one that's on my charts is CH for chart. But you can see that, I don't know about some of these stocks are really cheap. You got to be careful there. But $25 stock, Neon, look at where it is. Right now, implied volatility is at the top of its last year's range. So therefore, it's more than likely to have overvalued options. So we'll take a look at Neon. Again, there's no guarantees, but it's more likely to be overvalued. 25 calls at 840. If the theoretical value is only $1.28, yeah, that's a little bit overvalued. 45-cent theoretical value, and you got to pay $8 for that thing? No, I don't think so. Right? That's kind of an extreme. This, I believe, is probably a thinly traded option or even security. So that's one thing you got to be careful of with some of those hot lists. Instead of looking at just highest, and I can go for more. Let's see. I'll do 100. Let's sort it by price. And you see these are all $17, $100, but the open interest is a little low too. ETHU. And that's in the middle of the range overall. And this is percentage of the historic volatility. So it's not the actual number. If I go again to my indicators, I think I still have it open. Yeah, implied volatilities. I just turned status off. There we go. You'll notice the line, the blue line is the same as the yellow line underneath, because that's what it's plotting is implied volatility, but the numbers aren't the same. That's because that's showing the percentage in relationship to the high and low of the last year's historic volatility. So that's not your implied volatility number. Your implied volatility number is actually 1.49. Okay, be aware of that. But again, I'm just looking to see relatively, are we high or low? Are we getting cheap or expensive options? So those are two indicators that I use on a regular basis for myself, and you just put them on your chart. The nice thing about TradeStation is they're pretty open and pretty easy to use when it comes to indicators, at least in my opinion. If you have a question about it, for instance, implied volatility, all options, what the heck is this and what is it really telling me? You click on it, click on definition, and it'll tell you pretty much. The help thing pops up and it tells you market synopsis, and you can research more on it if you need it. So that's nice. So again, another way of looking at high implied volatility and overpriced might just be percent change up or breakouts, or right there, implied statistical volatility versus implied volatility ratio lowest. That means that it might have really high implied volatility and low statistical. But again, you want to be a little bit careful with amount of open interest. 200 is not very good. Pesky, PSKY, what is that? And it's not showing me this range percent, unfortunately. So it won't work on all the with all the securities. But again, if I can look for implied volatility, biggest changes up. And if I'm looking for securities that have overpriced options, this might be one, FL. And so we got Foot Locker that has high implied volatility compared to its average and compared to the last year as well. There it is. You can see that it's very overpriced options. I mean, the implied volatility is extremely high, which would suggest there's likely to be, not guaranteed, overpriced options. Check out Foot Locker. And again, just check the theoretical value compared to what it's trading at. Theoretical value for the puts at the money, 83 cents. They're charging $3 for those. Yeah, that's a bit overvalued. Even the calls around $1 or 83 cents, and they're definitely overvalued. Again, I got to do this while the market's open, obviously, to get better pricing. So that answers hopefully one question about the workspace. I just create my own workspaces. Some workspaces for individual option strategies are already available and built right here. Like you see, download workspace. You can download all the different workspaces. Where is it here? If I were to go to open workspace, downloaded pretty much all of them from the Options Education Center. So you got bear call diagonals, bear call spreads, bear put spreads, bear call diagonals, condors, butterflies. So there's a bunch of different workspaces for individual strategies in the markets as well. And of course, the education is also available there. So another question that came up, could you provide backtest results? When you're talking about protecting a portfolio, I don't really have backtesting results because we haven't actually been through a bearish market to be able to explore using that particular strategy for a while. And when you take a look back, for instance, SPY, there we go. And I don't really care about all that other stuff on the bottom at this moment, but what I'm looking for is, again, if we're expecting a downturn in the markets or an increase in volatility, currently implied volatility on the broad market is relatively low. You can see by using this as a gauge for the broad market, it's also below the average. Markets are mean reverting, and you can see it right here. If I go ahead and remove this again, look at what happens with that average price. and the blue line, which is the implied volatility. When we go below it, we usually snap back. We go below, we snap back. We go above, we snap back. And another way of looking at implied volatility, you could actually add Bollinger Bands to your chart. So if you were to add Bollinger Bands are a measure of volatility as well. They have a lot of different uses if you know how to use them properly. Let's see, we'll do mid. Let's see, I like the same color for both. So use contrasting color. Yeah, let's see how that looks. There we go. So implied volatility in the Bollinger Band, basically it's showing you standard deviations from an average, which in this case is typically a 20-period moving average. Should actually be 21. It's not that it really matters too much, but on a daily, typically it's 21. That's the average number of trading days in a month. That's why. And if you really want to get technical with it, excuse me, implied volatility for intraday bars. Yeah, unfortunately, it only calculates on the daily for the numbers that are given to the brokerage, I believe. But yeah, I was going to say is that this 21 length should actually be an exponential moving average that's built off of. I don't think I can change it unless I were to code the easy language, which you could easily change it if you know how to do that. Anyway, what happens is when volatility is relatively high, you'll notice the bands are wider. If I go back a little bit, you see it. When the bands widen, volatility is going up. When the bands contract, it's because volatility is narrowing, or the bands are narrowing and volatility is dropping. And just as a whole, even in the smaller moves, again, if I get that big jump out of there, you can see right here, implied volatility rose a little bit. It didn't really expand too much. It started going down, the bands contract, and the bands are lagging a little bit. But overall, when you have narrow bands like we do right now and implied volatility is relatively low, that often leads to mean reversion. That it basically says that the volatility should go back up to the average. And often when it goes to the average, it'll overshoot it. It doesn't go just straight back, kind of oversteers in your car, just an extreme, the opposite side, unfortunately. So we may be getting ready to experience a major shift in implied volatility from where we are now low upwards. And you can also take a look at the volatility index, which is the VIX, which is something else we can chart. And we see that the VIX, and that's not going to give you implied volatility on implied volatility. So this VIX or VIX.X is the implied volatility index for the S&P 500. And it is historically low, below averages. And the volatility on the volatility is also relatively low. The bands are relatively tight, not as tight as they were, but they're pretty tight in comparison to where they've been in the past. So all of that is suggesting that we may be getting a large move in the markets very soon. If we happen to get some inflationary data on Friday, that could be a catalyst for a jump in the markets, and not a jump to the upside, a jump to the downside. In addition, again, you can go ahead and do more analysis on the broad markets. I'm not going to do all that right now because, again, we're trying to focus on what's happening with protecting our portfolio and how we can do that. But basically, I mentioned in the workshop, there's a formula that we use. And if you go back to the slides or the recording of the webinar, you'll see this little particular slide. And basically, we can use ETFs like SPY or the index options, which is the SPX. We can actually trade those options, or SPXW.X, whichever one you want to use. And you can use those to hedge yourself, meaning if the market drops in value and your portfolio drops in value because it's very tied to the broad market, you can gain in your options position, predominantly buying puts on the index, and that would gain in value relatively similar to what you're losing in your portfolio. Now, if you have to worry about the taxation issues, if you're doing it outside of a tax protected account, if you're able to do this in a self-directed IRA, then again, you have different taxation issues. I can't go into all that because I'm not certified to talk about those, but talk to someone who is. But basically, let's say you've got a portfolio you want to protect. Let's make it simple. Let's say you got 100,000. Okay, so you got a $100,000 portfolio. This is the formula you want to use right here to figure out what's called a full hedge. Now, you got to be careful with a full hedge. With a full hedge, if your portfolio goes up in value, if you've got a full hedge, you make nothing because you're losing on your options position 1-to-1. Okay, so a lot of people won't do a full hedge. They will actually hedge maybe 60, 70, 80% of their portfolio just to kind of soften the blow of a bear market if things were to turn down, or not even a full-blown bear market. Sometimes, again, let me go back to SPY, you experience just small downturns in the markets that last for a few months, maybe even just a few weeks. Like in April, you see, we had this turn April 2nd, and that was tariff time, right? And eventually we recovered pretty much before the end of the month. It came right back up, but there was a little bit of nervousness and potential for it to continue down for a while. Actually, in fact, we started turning down here in February. If you really want to call it what it was, we had a downturn in February and didn't recover completely until June. So we had about a 4-month time frame where prices had turned down, and obviously portfolios recovered, but there was 4 months where they were not, that you were underwater. So if you expect something like that might occur, you try to protect yourself. And let's take a look back real quick at that situation. The markets were pretty bullish, going up and up and up. Look at volatility though, low compared to the average. Remember what I was saying before, when you get low volatility compared to the average volatility, there it is in February, you're likely to snap back and possibly overshoot. And that's exactly what we did. We were down and we shot back and overshot. And if we get inflationary numbers on Friday, that could absolutely shock the market like that. Another thing we would look for, and I actually mentioned this in the workshop too, but we could use other indicators to look to see what the markets are likely to do direction-wise. Also, the bands narrowed. Again, I mentioned that was an issue, that if the bands narrow, could lead to a explosive move in price. And I actually use, wait a minute, do I have it on this one? Or bother? I do. I use RSI. So if I bring up, actually, got the futures right here I was looking at. And the NASDAQ, I'll use that as an indicator. And let's see, we'll go out to a daily on the NASDAQ. And what's happening right now on the NASDAQ is a little concerning. We've reached up to some highs and pulled back off 24,000, no big deal. But we had what's called negative divergence, where prices made highs while the indicator made lower highs. And this is what I'm watching right now, because negative divergence is just a warning sign on its own. It's not a reversal signal. You actually need a little bit of confirmation after that. And confirmation can come in a couple different ways. Okay. I'm not going to go into all the details. I think I did a YouTube video a while ago on how I use it. But basically, what I'm looking at right now for confirmation that we might be going into a trend reversal on the NASDAQ is if we make a high in price where the RSI fails to get above 60, that would be a bearish signal for me in the markets after a negative divergence. So what is a high? We have to have a high in price with a lower high on either side and also a lower low on either side. So we haven't completed that yet. So I'm not ringing the bell saying, hey, here we go. Sky is falling. Not yet. No, we have a high right there, lower high today, lower high before it, but we haven't made the lower low on the other side yet to confirm this as a peak. So we could just be pausing before we rally. And then this would have just been a warning that we had a small pullback. So there's no reason to panic. But if we actually do make that other high, we will now have made part of a downtrend, which would be a lower high. The downtrend would be lower high followed by lower low to make it official. And of course, if that happens, you probably want some protection for your portfolio. So going back to our formula, let's say we want to protect 80%. What we would do is just plug in 80% in this number rather than the full value of our portfolio. Then we got to choose which spider strike price we're going to want to use. Okay, we can use at the money options. The problem is they're a little more expensive. And the thing that we're looking at here, initially, I just talk about this and how much you're protecting. Again, it's all in the workshop if you want to watch the video. But when it comes to the formula, we also started to deal with delta, because if you're actually trying to hedge yourself, if you buy an option with the intention of only buying one option to protect 100 shares, you would actually have to exercise your put and to relinquish your shares, sell them. We're not trying to do that. What we're trying to do is profit from the downward move in the underlying, so the puts go up in value just as much as we might be losing in our portfolio. So we need to do what's called delta neutrality. Not exactly one-to-one though, because again, we wouldn't make any money if the market goes up. By doing this protection, you are going to limit yourself. If the markets continue to go up and we don't need the protection, you're only going to gain 20% of what your normal portfolio would gain because you're losing in that options position. Understand that. So you only want to do this if you're fairly certain the markets are going to have a pretty good turn to the downside and you want to protect yourself. Is there some danger? So we get to go ahead and choose strike prices based on how far we're expecting prices to drop or how much of a cushion we need. At this point, this was chosen because at the time, I think prices were trading around 620 on the SPY, and we were saying it would be about a 5% pullback in the markets before we needed protection. So obviously numbers are different now. So if we go to current market, where are you? And I'll just, again, use SPY. We're currently at 642. Okay, we'll make it easy. We'll call it 640, right? So 640 minus 5% would be 608. So we might choose 605 or 610 puts. Okay, so we go out to our Option Station Pro. And let's get the rate SPY. Now, the other question is, how long do you think you might need this protection? Because we don't want to have to buy extra protection and spend more money than we need. Time is money when it comes to options, but we definitely don't want to buy anything that's going to expire within 30 days because the time decay is going to erode the value of those options. Our plan is either to liquidate the options and recoup value to cover what we lost, or if we end up not needing the protection, or even if we did use the protection, we still want to have some of that time value left. So we want to have as minimal time decay as possible. I typically go out at least 90 days. And my preference is I try to figure out, okay, our last pullback lasted about X number of months. Remember, we had 4 months of that last pullback. And we can look back and it's going to be anywhere from 4 to 6 months on average. Add an extra 30 days to that. Because again, you don't want to have 30 days left till expiration or less when you liquidate the position. So if we were to go out, 180 days would be 6 months. That's probably more than enough. Maybe I go out to the 200 days or 217, the quarterlies, March 2026. Again, it's going to be more expensive to buy those than it would be to buy something only 90 days out. 610, what are we looking at? Here, the puts are 1724. Here, I need more strikes, more net. Actually, I could type in a different number, can't I? Let's do 50. I found that out. I didn't realize you could do that, but you can actually type in how many strikes you want to see, which is kind of nice. Oh, almost there. So let's do 60. Almost there. 610, there we go. Yeah, see, it's only $8.33 versus 17, so it's half price. But it's also half the time. And again, the time decay, 14 cents per day or $14 versus, oh, no, too few. What is the 610s? Here, it's not that much different on time decay, 11 versus 14. But again, if we need this for 4 months, I only had 3 months of time. And technically, I only had 2 months on a 90 days because, again, we go inside that 30 days and it starts ticking away. So it's worth it. A lot of this I'll get back. It's just initial upfront costs, of course. So let me clear this out. And I buy the 610 put. So there it is, 610 put SPY. And it's basically protecting me for about $61,000 of a portfolio. That's not how much protection I need. Remember, my portfolio was 100 grand. However, if I wanted to protect 80% of that, I need $80,000 of coverage. So I can adjust a little bit if I want to based on the strike prices as well. Or the other thing I also need to take into consideration is my delta of the option. The delta right now is about 27 or negative 27. Okay, so the formula that I was using is right here, 100,000 divided by, but remember, we're using 80,000. The strike price, which I chose 610, times the delta times 100 shares. So the strike price, 610, times 0.27 is the delta, times 100, that's 16,470. That's the bottom right there. So I'm going to divide that 16,470 into my 80,000. Divided by 16,470. And I should do roughly 5, I'm going to round up, 5 puts. So if I do 5 puts, obviously my cost goes up, right? So it's $8,600 now to buy that insurance. That's almost 10% of the value of my portfolio. But again, I'm not actually going to spend a full 10% of that value because I should be able to recoup some of that in time value when it goes at the end of the position. What happened here? Showing me theoretical P&L. It's looking weird. Maybe I'm zoomed in too much. That's why I was going to say it didn't look like a put. There we go. I was wondering where the other arm was. So if we do get that 5% drop, there we go. you can see that if the portfolio drops by 5%, and again, it was a $100,000 portfolio, 5% would be a $5,000 loss, right? Am I completely hedged? No, I'm not completely hedged. If prices go from where they are now and it drops, most likely volatility is also going to rise a little bit. Let's say it goes up by about 3%. Okay. So volatility rises because the markets go down. The put is going to go up in value that I bought. And look what happens. Actually, we can estimate a little bit more on the volatility. Oh, I disabled the indicator, didn't I? Where's here? Implied volatility status. Current implied volatility is what? About 13%. We're expecting at least to go back to the average. That's about 16. So we'll say, yeah, 2.5% or 3% rise in volatility if the markets drop. That's not the end. I'm sorry. At the end, come on. There we go. 13. And that's only going to go up about maybe 1.5 to 2 points. But remember, if it does overshoot a little bit, it could go up as high as 16. So we'll just say 2.5% rather than the 3 that I put in. Okay. So if the prices drop down to 610, that 5% drop that I expected, and the volatility goes up by 2.5% as expected, those puts would make $3,700 that would cover a portion of the $5,000 loss that I had. That's how it works. It's not 100% hedged, but I didn't want it to be. I only wanted to protect 80% of the value of my portfolio, not 100%, because I still want to participate if the markets go up instead of down. I'm just reducing my participation, but I'm protected against some of the time decay. And we can actually also use the time decay to help us out as well. I forgot to add that if I wanted to really get a little bit more accurate with this, I can go ahead and say, okay, maybe that's going to take us. Let's see, we've got how many days till expiration now? 217. We can back off maybe 30 days of that to about 180 days or so. There we go. And we plot to that day. And actually, look at that. On that day, that value is about $6,700, which is actually more. Remember, I rounded up. This makes sense because I rounded up, not down. Remember, my protection, according to my calculation, was, I deleted it, was 4.85 puts that I need. I rounded up to 5. So I'm overhedged. Now, here's the other thing that's going to happen. When the prices move, my delta is going to change. Currently, it's 136. For a completely hedged delta, it would just be 100, negative 100. Now, when the prices have moved, my delta has gone up too much. I actually want to keep that closer to 100. So what would I do? I would sell some of those puts that I bought. If I sell 2 of them, now I'm down to 124. And I have 3 puts left to cover me if prices continue to drop. And I still have the hedge going. It's dynamic. You have to keep an eye on this and maybe check it once every 2 weeks, maybe once every week, and adjust if necessary by selling one of those. If the prices go up rather than down, you may need to add to protect yourself, to keep yourself somewhat delta neutral. Okay. So that's a little bit of an example of kind of using this and back testing in a way. Lewis had a great question as well. Would a short talk about probability cones be appropriate here? Yeah, there's a tool that we can also use in TradeStation, and it's giving you an idea of forward-looking where prices are likely to go. And you can do more studies on the options and some of the deltas as well. But basically, one of the tools that we have in TradeStation under studies, as I go to add study, is a probability map. And you could look at, and there's 2 different ones. There's normal distribution, normal range. Again, if you want to know the difference, you go to definition. But basically, it's going to give you this, looks like a rocket ship taking off. You got to make sure you have space on the right. If you don't have it set up, you just grab price and pull it. And basically, that's what we call a probability cone based on volatility. Now, remember, volatility may rise and probably will rise, especially if we start moving down in price. But this is giving us an idea of, in the future, where prices are likely to go. It only goes out a little bit, though, in this case. Why is that not going further? I haven't used this tool in a long time, so I'm not too familiar with it. You can see it goes from 826 and then just 9.1, it locks in. So I'm wondering if space to the right, let me see, if I do 30, I don't know if that'll increase it. That's what it was, the space to the right. So if I wanted to go out, say 30 days, I could go further, but the problem is with the probability cone, it's not going to be as accurate, even though it's giving you, but basically what it's doing is shading the highest probability of where prices are likely to be in the future based on volatility. And that's what volatility gives you in a way. It tells you, for instance, we have 13% implied volatility right now, 13.5, we'll call it. That means right now, looking forward in the future, the prices are likely to be 13.5% higher or lower 1 year from now. That's what the current volatility is telling us. That's basically what the volatility does. So looking at the SPY, what do we have here? We're currently at 642.47 times 0.135. So we'll go up 86% or 86 points up or down within the next, 30 days. That's the expectation, the next 30 days of volatility. That's what the implied volatility is. In the next 30 days, the price of the SPY should be either up 86 points or down 86 points based on current volatility levels. But remember, volatility levels don't stay static. They go up and down. So it could be more, it could be less. But based on the current volatility in the markets, that's what we're expecting. If we're also low in volatility, we should expect volatility to go up. So we know that we should be higher than this. And we're probably going to be somewhere in the mid 90s in 30 days from now. So we have 86.73 plus 642.47. So 729 on the upside. I should take off the snap mode somewhere right there. And on the downside, so basically it'd be 86.73, roughly 555.27 in that area. I'm not going to get exact. So going forward, if volatility is likely to go up as well, of course, as I said, let me see here, bring this back. There we go. That's based on current volatility levels. That's our range of where we're likely to go. But that's what this is telling us. This cone is by going out. If, for instance, if we start dropping in the markets, this is where we're likely to be. The yellow is the highest probability of where we're going to be. And the lighter the colors or the more red it gets, or I guess it lightens, but that's a cone of probability going forward. And based on, let's say we were looking out 1 month from now. So today's August 25th, we go September 25th. We can see there's a high probability will be between about 630 and 660 in that window. So it just gives you an idea of how far prices might rise or drop going forward there during that time. That's all. But again, I'm not really too keen on using that. It's something that you can experiment with. And of course, let me remove that there. There's the range one as well. So let's see, what was the other questions? Actually, one I already answered in the class itself. And that, of course, if you have questions, you can type them in as well. Someone asked, oh yeah, June asked, does it make sense to open a stock position and protected put at the same time? Absolutely, you can. And that's something that's built into TradeStation, believe it or not. So if I go back to my options and we go to spread, right now I'm using single spreads, but if you do covered married, basically, if you were to go ahead and buy a stock, in this case, I got SPY, I choose the price I wish to buy. It'll also buy a put at that strike price. If I choose the put, analyze buy. So right here, go analyze. Actually, no, let's do this. I'm going to take these off, delete those positions. Okay, go back, trade. There we go. And let's say I want to buy around 642 current price in that area. So basically, I'm buying 100 shares and I'm buying one put. I don't have to buy the put at the same strike. I can actually adjust that strike right here. So again, maybe I want to buy that put at about 625. There we go. And I would just have to adjust my prices accordingly. This is showing you the price of both the option and the stock. I don't prefer to do it this way. I prefer to just do the individual legs where I would just buy the stock and then buy the option itself separately. That way I can see the pricing and all the everything else different. But if you want to analyze it together, you absolutely could, and you could trade it together. It is available, but I prefer to just do them separately. And then what was the last question that was there? A bit off topic. What's your take on looking at unusual options activity? Yeah, I mean, there's definitely something to be said about looking at unusual options activity. You're talking about large buying or large numbers of selling. Absolutely, there's something to be read into that. I don't look at it quite as much, but I do look at open interest and what's called pinning. And it's funny because pinning technically is very illegal. Pinning is if there's a large open interest. Let me change my view here, customize the columns to open interest and volume. And for now, I'll just get rid of the Greeks. On the SPY, well, be too much and too much unusual activity typically, but sometimes you can see, for instance, right here, we had huge volume and lots of open interest in the 645 calls. And actually, there's huge open interest in 650 calls. Now, are those people trying to buy those calls, or are they trying to sell? Technically, somebody had to do both, right? Somebody had to buy and sell. But here's the kicker. When you look at professionals in the markets, they tend to lean a little bit more on the sell side than the buy side. Okay. I've talked to a friend of mine who's a specialist. He used to be a SIBO specialist at the floor of the exchange. And basically, what happens is that when you think about an option, for instance, a call, when you buy a call, you only profit if the prices of the underlying go up, the value of the option goes up, right? But when you sell an option, you don't just profit if prices go in your favor. You have three different ways of profiting. You could profit if prices go in your favor, or if they go sideways or nowhere, or if they go just slightly against you, because you've got time decay and volatility that you're playing as well. So you don't have as much of that on the long side of options. Buying a put, you need prices to go down versus up. Okay. So when it comes to professionals, it's higher probability to sell options than it is to buy options, probability for profit. So that's why you're seeing that. If I look at this and I see there's a huge open interest at 650, my mind says that's probably a lot of professionals who are not expecting prices to go above 650 because they have sold 69,000 contracts there. Now, what's pinning? If there's a large open interest, even here, 645, as these are getting closer to expiration, you probably see it even more today if it still shows me this information. Let me see. Yeah, look at that volume. By the way, that's day trading right there. When you've got numbers on volume that are much, much larger than the open interest, that's because people have been flipping those and day trading them. But basically, what you want to look for is if there's a large number of options of open interest, and here there wasn't really anything huge that stands out, honestly. We went from 2,300 to 4,500, and then there we also doubled from 4,400 to 8,900. Typically, if you've got a large number, prices will typically stay just under that number at the expiration, because what will happen is the market makers or the professionals who've been trading that will try to push prices to keep those options out of the money so they expire worthless. That's called pinning. So here, I'm surprised it actually finished as low as it did, because there was a huge open interest here, 643, 644, 645. All those puts finished in the money. And if there were professionals selling those options, they got stung. There's what's called option pain. You'll notice, though, right there, 640, we had a floor put in. There was a bunch of open interest at 640, 16,000. That stands out. That's what you're looking for. Those options are more than likely going to stay out of the money because of pinning on the expiration. It mostly happens on the quadruple witching, which is the fourth Friday of the month on March, June, September, December. That's when everything expires, options, quarterlies, the futures, all that stuff. So it happens to a smaller extent here on the SPX or SPY even. But yeah, when you see that things like that jumping out, I would expect that to stay out of the money. And if you saw something correlating to that on this side, where there was a larger number compared to the other ones around it, you can almost see a sandwich in between those two. You're going to end up closing inside that range, and you could possibly play it accordingly. So real quick before I wrap up, let's see, for us new traders trying to learn TradeStation day trade options, how do you see what you're risking per contract? Oh, yeah, very easy. And TradingView, you create a long position on the chart, tells you how much you're risking. Oh yeah, there's absolutely easy way to see that in TradeStation. A couple ways. One, it depends on what you're trading and how you're trading it, because if you are buying an option, you're limited in risk. It tells you right here, max profit, max loss. You cannot lose more than what you paid for the option. But when you start doing, let's say you're doing a bear call spread, right? So it's a debit spread, or sorry, credit spread. I'll go out a couple days here and we'll sell and then buy higher strike. It'll still tell you your max loss. And of course, if you analyze this, you could see it on the option price slices and the profit and loss risk profile is what this is called. The chart, the risk profile. And you can actually change to however many days are left to expiration, all that good stuff to chart that out. Additionally, there's a tool that I helped create in TradeStation. So if we go to the browser here for TradeStation, where is it? It would be under Options Education and Trade Planning. I'm trying to remember where that stuff is now. The Jesus might have to help me out with that because I don't remember where they put it. But there was on the planning.
What you looking for?
The calculator we created for the options for planning.
Oh, that's in the getting started to learn.
Ah, okay.
I believe it's getting started, right? Or yes. And then you have to scroll down to trading plan.
There it is. Okay. So yeah, if you go to getting started under learn and you go to build your trading plan, step 6, there it is. And I guess I click on that right there, build your
Yes.
plan. There are some downloads that we created, a spreadsheet that I created. One's an overall business plan, and there's a workshop for that, or works basically downloadable works spreadsheet. But right here, market opportunity plan, depending on which strategy you're using. I obviously have different copies of this available as well, but I use the one right here that I just downloaded just to show you. There we go. So depending on what kind of strategy are you doing, if you're just doing a long option, you just put in, are you bullish or bearish? You just enable editing first. There we go. So let's say I'm bearish. Okay. It knows I'm doing a put if you're bearish and going long. Or if I'm doing a spread, bull spread or bear spread, straddle, strangle, it'll give you your targets and potential profits versus risks based on the inputs you put in there. So it'll help you track all that. But again, in TradeStation, this is in addition to TradeStation, obviously, it's an extra tool that we created to help understand your position. And it even shows you what the risk profile looks like. So if I'm looking at, yeah, this would be a straddle, strangle, or iron condor or butterfly. You could do either a long iron butterfly or a short iron butterfly, depending on which one you want. Let's say we're doing a credit. Okay, that's this one. And it'll start populating the risk profile there and show you your rewards and risks and all that good stuff. And of course, again, when you're building that inside of TradeStation in the platform, for instance, I go back to options, I'll just do Tesla, do a butterfly there. I build them out individually. I don't use the filter, but you can use the filter if you wanted to. Yeah, do a short butterfly here. So we'll sell 345, call and put, and then buy, let's say 340 put. What? Oh, I have too many legs open. That's why. There we go. 340 put, 350 call. And it recognizes an iron butterfly right away. And I already see my max profit, my max loss. So I stand to make 472. I stand to risk 28 bucks. And I analyze that. And there we are. There's my iron butterfly. And I can see exactly how much I'm risking or potentially going to be making when I slide this around. And I can also use the price slices for it as well. Additionally, I can go back to the worksheet, iron butterfly, Tesla. Long put was 350, I think it was. Let me see. No, sorry. Long put was 340. 350 was the call on 345. So long put, 340. How much premium? I just have to go back to my option chain and just fill it out. So it helped me get that information. If I just use retail pricing here, let's see at 13.15. Long call strike, 350 for 15.95. Expiration, I know it doesn't matter right now. I don't have to fill that in. The short put strike was 345. And the premium for the put, 15.45, same strike for the call, and that was 18.15. And let's say we want to do 3 butterflies. There we go. So there's a premium credit I'm going to be receiving, total credit I'll receive, and let's see, my initial margin that I need based on the amount of risk that I potentially have because of the legs of the butterfly. It even shows me my break-even prices there as well. Automatically fills it out for me, which is cool. Can you put an activation rule buy to close at 50% profit? Chris, great question. It is difficult to do that, but it is possible. Yes. The reason why it's difficult is you cannot set the activation rule buy to cover based on the underlying premium. What you have to do is first go to your price slices. I was there. What am I doing? I go to my price slices under analyze and figure out what underlying price would cause me to lose 50% or if it have 50% profit, either way, for loss or gain. Once I know that underlying price, and unfortunately for this one, it's going to be more of a time decay thing than it is a price thing. So that's not really going to be possible here because I can't set my activation rule. That's the wrong page. That's the one drawback. I can't set my activation rule based on the underlying premium of multiple options. I can only do it on one option if I had it.
Yeah.
Yeah, if it's one option, that's no problem. So if you were to buy a call and you wanted to make sure once you got 50% profit or even sell a call, you just put the symbol of that call here, add it and say if the value is at or below or at or greater than a certain level, then you go ahead and exit. And it would just be a market order to exit, and that'd be fine.
Yes.
Fortunately, for multiple legs, you have to fill out the strikes first, figure out the price slices first.
And our engineering team is working on new features, new things that are coming up. So stay tuned for all the great stuff that TradeStation will continue to offer.
There you go.
Brandon, it's great,
Yeah.
great presentation. I've linked that presentation you did on Plan the Trade, the plan. It goes into a little bit more detail on that worksheet that Brandon was showing everyone. So make sure that you watch that video if you'd like to learn a little bit more about how to use it. And also for any other follow-up questions, please email us at education@tradestation.com. We're always attentive to your comments, your questions. And if you send us a question for Brandon, I'll make sure to pass that along to him so he can respond. Brandon, thank you so much again. Everyone that attended this webinar, thank you so much for your time. And I look forward to seeing everyone in one of our future events. Thank you. Have a great day. Bye-bye.